The RBA has delivered an increase in the cash rate from 3.6% to 3.85%. It's the first decision of the RBA's calendar year, and this was a widely expected move, with financial markets pricing in a 70% chance of a hike, and the majority of economists betting the same thing after that hotter than expected inflation number received for the December quarter last week. So recapping, the RBA has lifted the cash rate by 25 basis points, or a quarter of a percentage point, to 3.85%. Now, if the banks decide to pass this interest rate increase on in full, it's going to cause extra pain for those with mortgages. For a 25-year loan on an average interest rate at $600,000 a year, borrowers will pay around an extra $90 a month. Now, for those with a mortgage of $1 million, that goes up to around $150 a month, and you can see there those payments at various levels of mortgage and interest rate and mortgage repayments. So let's say for an average $700,000 loan, the repayments per month will increase $105 per month, and that is over a 25-year horizon. Now, CanStar has put together that research. It says if there has been a 25 basis point hike, which there of course have, then an average variable rate now would go up to around 5.77%. When it comes to savers, they obviously are set to benefit from this, and CanStar says with an increase in interest rates that we've seen, a competitive savings rate would be about 4.5%. So standing by for us is Chief Economist at EY, Sherelle Murphy. Sherelle, this is not a surprise.
No, that's right. We've certainly seen the inflation numbers pick up recently, and as the bank says in its statement, materially, in fact, in the second half of 2025, which is, of course, the reason that they've decided that they had no choice but to put the cash rate up today to 3.85%. It is disappointing because, of course, it was less than 6 months ago that the Reserve Bank was cutting rates, and in fact, there's been a very sharp change in expectations over what's happened over the last 6 months. I think also that's quite unusual in the sense that we don't tend to see the Reserve Bank take only 6 months between the last cut and the next hike. So, yes, certainly an unusual set of circumstances at the moment.
Yeah, as you say, it's a big U-turn in the cut from August to now a hike in February. I mean, was the August rate cut a mistake? Is the RBA's credibility at stake here now that it's had to hike in such a short period of time?
Look, there is certainly a possibility here that that obviously that last rate cut wasn't needed. But to be fair to the Reserve Bank, that was not obvious at all at the time. In fact, it looked like the inflation numbers had been coming down quite nicely. Now, obviously, that's not turned out to be the case, but there's a few sort of moving parts in the economy right now. A cash rate of 3.6% we thought was basically around neutral. In other words, it probably wasn't, or we didn't think that it was sort of pushing up inflationary pressures or bringing them down. But it turns out that actually that might not have been the case. The economy just can't sustain too much stimulus at all before it starts sort of breaking out, unfortunately, in the form of inflation. So, the Reserve Bank certainly will be adjusting its inflation forecast to take account of that. And certainly it looks like they did certainly underestimate how bad those inflation pressures were.
And Sherelle, we're just bringing up a chart of the most recent rate moves, which shows those 3 interest rate cuts stepping down from the peak of 4.35%, coming down to the 3.6% we saw in August last year. Those moves were in February, May and August last year. And that very quick turnaround, which is a perfect U-shape on our graph, of now back to 3.85% in February. Now, in terms of this turnaround, do you think it's a recalibration in policy? Do you think we're one and done, or do you anticipate we could see more rate hikes from here? The market is pricing into by September.
I think it certainly could result in more rate hikes because the inflation problem isn't under control yet. Of course, what we need to do is watch the data as it comes through. I must say that the data that we've had so far this year has probably surprised me a little bit to the upside just in how strong it's been. And that, of course, tends to be something that runs in line with stronger inflation, and particularly the labour market, where the unemployment rate fell again to 4.1% from 4.3% in December. That was a bit of a surprise. We've even seen things like job ads pick up again. So it does seem like the economy is just running a little bit too hot. Now that certainly will be tamed by this rate hike, and in fact, the possibility that households were expecting that may have started to impact the data already. But again, we just have to watch how the data unfolds over the next few months. But yeah, I certainly wouldn't rule out another rate hike later in the year.